Thank you. Welcome to the Kentucky Retirement Systems Investment Committee meeting. It's November 21st, 2024. And thank you all for joining. Let's see. Do we have an opening statement?
Yes, ma'am.
Okay.
For the record, I want to note that this is the regular meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Sherry, could we do a roll call?
Yes, ma'am. Ms. Boba,
Here.
Mr. Lane, Mr. Atkins, and as I'm calling her name, Ms. Thompson is coming on. So if we will just give her a moment, we can do a mic check. I will make sure that she is noted. Good morning, Ms. Thompson. We were just doing a roll call.
Okay, good morning. I'm sorry to be late.
No problem. Thank you. Okay, Ms. Boba.
Is that it? Okay, thank you.
Yes.
Okay, so Sherry, there's no public comment?
That's correct. And as I'm speaking now, Mr. Atkins is coming on. So
welcome, Mr. Atkins.
Yes, we'll give him a moment. We'll make sure that he is connected. Good morning, Mr. Atkins. Hello. You're very low on your sound, but I saw you wave. So we just did roll call, and so I will notate that your attendance today. Thank you.
Thank you.
So Sherry, should we move on to the approval of minutes? Do we have enough people now?
You can.
We do. Okay.
Yes. And I just wanted to make sure, I wasn't for sure if I mentioned, but we had no public comment for today.
Oh, thank you. Thank you. So assuming everyone has had a chance to review the minutes, is there a motion to approve the minutes of May 16th, 2024, August 21st, 2024, September 6th, 2024, and October 22nd, 2024 as presented?
So moved.
Second? Question. That's a question mark after that.
Second.
Thank you. Any discussion? All in favor?
Aye.
Aye. All opposed? And the motion is adopted. And we will move on. Okay, so next up, we have the investment review and update from investment staff and Wilshire.
Good morning. We're going to have Wilshire start with the economic and market update.
All right. Thank you, Steve. David and Craig, you're on. I think Chris is going to be joining us as well. A lot has happened since quarter end, so we'll probably keep some of these comments brief. But I'll open with, if we could please go to page 17, and I'm going to advertise the Wilshire Client Conference, which will be in April. And just to say a little bit about this, I think we've only had 2 years with you during which we had our conference, but our conference ran annually for somewhere between 35 and 40 years. And then COVID sort of shut that down for us. So the last one was 2019. This is our first one back, and we're planning it and we're excited about it. So this is an invite to everyone, board, staff, investment committee, etc. Just to let you know, these conferences, we've really worked hard to make these great for clients. Historically, it's just almost all presenting our research. There'll be some nice meals, of course, and things like that, but it's presenting our research and just going through one thing after another of investment topics for 2 days out in the Ritz-Carlton, Rancho Mirage, California. So we hope that some of you could come and join us for that event, and know that there are, government rates and things like that available, and all that kind of stuff. So big invite for you, and you'll hear about it again before we get there. So I'll go from there. I think, Craig, you want to go through maybe the first part of this capital market piece, and then I'll come back and hit on a few highlights too.
Yeah, and I'll start on page 20, looking at rates. So like David said, a lot's changed since quarter end. So here, when we produced our quarter end slides, you can see the theme here was rates down, real and break even inflation. So you can see the top line, the nominal 10-year treasury, pretty consistent downward trend for the second and third quarter, with a slight uptick at the end of the third quarter. David will talk about fixed income markets and give an update on what the yield curve has done since the end of the quarter. But you can see even before the end of the third quarter, we saw an uptick in break-even inflation expectations that's priced into the 10-year, coming off just above 2% to 2.17. That number is up considerably since then, up to closer to almost 2.40, I think 2.35, 2.36 as of today. So real yields have stayed about the same, at the end of the quarter, even though break-even inflation expectations started to creep higher. We skip forward a couple pages to 22, update on inflation. We can see in the red and the blue lines, the core in blue, and CPI in red. So the overall CPI 2.5%, core a little bit higher. You can see those the 10-year break even I just mentioned, as well as the 2-year break even rate below both of those readings, and the shaded portion represents the Fed funds rate. And we saw the main thing I wanted to point out on this page is we see that peak in inflation and the Fed fund rates doing that pretty aggressive stair climb higher, and it has succeeded. I guess some of the decline in inflation might have been just structural, that was going to happen anyways with the relaxing of supply chain constraints. But the Fed funds aggressive rise in the Fed funds rate has seemed to have the effect of tampering inflation, albeit not to the Fed's preferred long-term rate, at least as of this point. And if we skip forward 2 more pages to 24, on a chart that's admittedly much too busy, we go into more detail. Wanted to point out here that the core services, the rent portion of services in purple, is this continuing pesky high number in the last 2 bars. You can see the last reading there over 6%. So we've talked about this in prior meetings. Goods, which they call it commodities here, but essentially you can think of the green line as goods. That's been consistently negative this year. And as we said before, consumers went from buying things on Amazon when they were stuck at home during COVID to wanting to get back out in the real world and spend on services. So goods inflation has been negative, services remains positive, and a big portion of that services is rent. And if we move to the next page, we've talked about this as well, but I think this is kind of a good graphical representation of what we said. The rent measure that's part of inflation, owner equivalent rent, is certainly lagged. And we can see in red and green here a couple of price indexes. So the Zillow rent index, which actually looks at rent for properties listed on Zillow, and the S&P home price index in green. Those numbers you can see in the earlier part of that upper section, or the lower section, which is just normalized to the end of 2020. Those numbers jumped higher. So actual rents and actual home prices jumped higher and have moderated somewhat. Well, the blue line is the owner equivalent rent that is part of inflation. And just based on the way that's calculated, it has had a slower rise because it is a delayed measure. So that's part of the reason why it's so persistent, is because it's still catching up with this huge jump in rents and home prices that we saw. But you can see in the bottom chart, the one that's normalized to the end of 2020, we saw that big jump in 21, 22 in particular. It's moderated somewhat, although home prices and rents are still rising, it's at a much slower rate. But the rate of change in the owner equivalent rent is a bit more smooth and still has quite a way to go, as that arrow represents, to catch up with what we've seen in the market prices. So probably expect that to remain a sticky component of inflation. That'll make it even harder for the Fed to get down to that 2% target, especially now that they've started cutting rates. So on the next page, 26, wanted to briefly point out that the rate of, or the ratio of job openings to unemployed persons has experienced a lot of volatility in the last few years, but essentially we're back to where we were pre-COVID. So there's roughly a job opening per person looking for a job now. So there were too few jobs and too many people looking, and that steep drop off we see in 2020, and then that reversed, and we were in a very strong market for anyone seeking a job for the last few years, and now the tables have turned a bit, and it's a bit more of an equal position of strength for people looking to hire and people looking to find a new job. So still a normal level, but a big change that we've seen in the last few years. So something to point out. Obviously, when there were 2 jobs for every 1 person looking, you can expect that wage inflation is going to be a lot higher when people have more job choices and there's a scarcity of employees or potential employees. So this normalization might help bring down the wage inflation levels. I'm going to skip forward quite a bit here to 30 and just briefly mention on economic growth. You see the last reading there is the 3% from the second quarter. We've had the advanced reading for the third quarter that came in at 2.8%. So that's the first reading. We'll have a couple of subsequent revisions potentially there. So still maintaining a pretty solid growth rate, although 2.8% is a bit lower than what we've seen on average over the last few years. I think the average has been closer to 3.2%. So just a hair lower. And again, that's just the advanced estimate at this point. On the next page, the consumer, we can see sentiment is still below the average over the last decade, but off of those 10-year lows that we saw in 21 and into 22. There is a measure of consumer sentiment where they ask the people who are surveyed what their opinion is of current conditions versus the future. And that reading tends to be a decent predictor of recessions, because when people think that they're essentially living in good times and they're pretty pessimistic about what's coming ahead of them, it's almost a self-fulfilling prophecy. If you're pessimistic about what economic conditions are going to be like, that can seep into your behaviors, and then next thing you know, you're spending a bit less than like I said, it's a self-fulfilling prophecy where there's less consumer spending because of the expectation of harder times ahead. So that's a potentially negative forward-looking reading from the consumer. There's a couple of other things that we keep an eye on, and I've mentioned in the past that we have a more in-depth quarterly market review that our CIO and former CIO, now senior advisor, put out on a quarterly basis on our website, and they go into more details. But some of the things they mentioned, the similar surveys to the consumer surveys that they've done for restaurants, and restaurants are already starting to see consumers starting to potentially tighten their purse strings a little bit. And then credit cards, that data I think we've mentioned before is sometimes hard to draw strong conclusions from the credit card data, because you're not always looking at the same pool of consumers, but we have seen a rise in defaults. How much of that is because lending standards relaxed in the last few years, and how much of that is because people are really pinched is hard to say, but it's definitely a sign that's pointing in the wrong direction in terms of outlook. And then I'll end on the next page, 32, business activity. Again, like I said, in the inflation section, people are looking to spend more on experiences than goods right now, and we see that in manufacturing. We've seen the manufacturing PMI be below 50, indicating a contraction for some time now, whereas services has generally been able to stay more positive in the last couple of years. So again, reflecting what we see in the inflation data here in these PMIs. And with that, I'll turn it over to David to talk a bit about what we saw happening in markets in the third quarter and then quarter to date.
Thank you, Craig. Sherry, if we could jump to slide 34, please. I'll just touch on quickly on three major asset classes and talk a little bit about what has happened since then. Spend maybe a little more data here to digest. This is the U.S. equity market. For the quarter, we had a 6%, 6+% return. Year to date at 20.6. So interestingly, this has moved quite a bit already. This quarter continues positive. We have a year to date. This is the top line, that FT Wilshire 5000 index. We have a year to date right now that is about 25%. So we've continued, as I'm sure you all know, to move positive in equity markets. Couple of interesting things to point out. Two charts on the right are the large cap versus small cap quarter by quarter. Most of the time, as we all know, large cap has outperformed. The very far right tick, that's this quarter, September 24 quarter, where small cap was able to win a little bit. And interestingly, that has continued in this quarter as we've continued to run. So the good sign about that is we've had broadening throughout the markets. I think even in our last discussion about this, we were starting to hit on broadening, meaning that we're getting away from it just being the Mag 7 stocks driving returns. And I think that's been a healthy thing for the market, but nevertheless, we're setting all new highs today. So U.S. equity market is up about 25% year to date. We also had, just during the quarter, we had over, if you look at the quarter, that first column, and then go about halfway down, you'll see U.S. large growth and U.S. large value outperformed growth. So that was a nice shift as well, 8.8 versus 3.0. As we've continued to run this quarter, though, growth is back in the lead. But small cap is in the lead too versus large. So just some interesting dynamics with all of that. But the takeaway is U.S. equity market's up 25% year to date. These are really high returns. I think we all know that well. Over to slide 38, please, just to touch on non-U.S. markets. I'll just take the top line of the ACWI ex-U.S. index. This is combining developed and emerging markets. It was an 8% quarter, up 15 year to date. This is now down this quarter, negative returns to non-U.S. markets. And then I'll go to fixed income on the very next slide, 39. And Craig talked about rates here. So if you take the top line, the Bloomberg aggregate index, we had a 5% quarter, and the 10-year Treasury had dropped 60 basis points from June 30, roughly 60 from June 30 to September 30. Got this nice positive pop, 5% return for the quarter out of the ag. We are now, if you look today, we're at 4.4 on the 10-year. So if we just take this quarter and roll it forward, we're back up 60. We have negative bond returns, and we're sitting on a year-to-date aggregate bond index return of 1.5. So these numbers are really stale, but it sets the stage for what happened in the quarter. But just know that these rates have gone back up, as I'm sure you've all seen. The Fed has done their couple of reductions now, but it's not convincing the market that they need to continue to be soft. And so this is just, this is what the market is doing. It's pushing rates up, back up 60 basis points. Mortgage rates dropped down nicely, came back up to where they were. And it's just the market's expectation about what they see as data and where investors are putting money. So I'm sure this will continue to be very active between now and December 31. So I'll end there and turn it over to you, Steve.
Thank you. Appreciate a good overview. The portfolios had a strong start to the fiscal year, consistent with the markets that David just covered. The KRS pension composite produced a return of 5.23% for the quarter versus the blended benchmark of 4.46. The insurance composite produced a return of, sorry, Sherry, I'm on page 46. Jumped ahead of you there. The insurance composite produced a return of 5.18% for the quarter versus its benchmark return of 4.46. The KERS pension portfolio returned 5.23, while the SPRS pension portfolio returned 5.29 versus their benchmark return of 4.45. The KERS hazardous pension portfolio produced a return of 5.19, and the returns for the insurance portfolios range from 4.75 to 5.42, compared to the benchmark return of 4.46%. Just kind of quickly for the quarter, as David mentioned, that things have changed pretty dramatically since the end of the first quarter of the fiscal year. But despite struggling early in the quarter as rising fears of U.S. recession led to a sharp rotation, as David mentioned, out of growth stocks and into value stocks, the public equity markets really began to stabilize in August as stronger than expected data alleviated kind of those near-term recession fears. And we're able to strengthen further in September. As David mentioned, the Fed began easing cycle by cutting rates 50 points and ended the quarter as the best performing asset class in our portfolio with a 6.61% return. Core fixed income also had a strong quarter with the benchmark producing a return of 5.20 as yields fell across the curve, with the drop accelerating with a rate cut in September. That's obviously reversed since the end of the quarter, but we'll get into that in a minute. Real estate markets continued to struggle, with the benchmark posting its sixth consecutive quarter of negative performance with a negative 0.66% return. Over the past 12 months, with broad public market indices reaching all-time highs nearly on a daily basis, including the S&P having its best 9-month start to a calendar year since 1997, the portfolios have produced very strong absolute and relative performance, with the pension composite returning 16.62 over the last year and the insurance composite returning 18.29%. Public equities over that time period have been the best performing asset class by a wide margin for the last 12 months, producing a return of 30.10%, while real estate has been the worst performing, declining by 5.90%. While October performance is not yet finalized, the portfolios did give back a little bit of that first quarter's performance. We're down between 125 and 150 basis points as markets cooled, with strong economic data sparking a repricing of Fed rate cut expectations. Our view is that the recent elections really may initially boost U.S. and global activity, and we're kind of seeing that play out in reaction in equity markets, but may lead to slightly lower levels of U.S. and world GDP over the longer term, with investment prospects dampened by uncertainty and higher cost of capital amid concerns about higher debt issuance by the U.S. and other governments, along with higher inflation expectation. Higher rates and volatility really may become the norm, especially as the new administration pursues expansionary fiscal and trade policy, which really just means a much more uncertain world. We've seen that volatility play out in markets. As David mentioned, we've gone from pricing in multiple Fed rate cuts to only, I think December is still a 50-50, so December looks like a coin flip, whether or not they cut again. And then expectations into 2025, into calendar 2025, have really been dialed back. I think the early expectations prior to, or at least at the start of the easing cycle, were for a number of rate cuts to extend into 2025. Markets are starting to rethink that. Wilshire covered the sticky components of inflation and what that might mean with the new administration coming in and looking for expansionary fiscal policy. What that might mean for monetary policy. So the Fed really is going to have to wait until that fiscal policy is implemented before recalibrating monetary policy. We saw Fed Chair Powell on the tape last week talking about, I think he's trying to talk down market expectations as far as what the market is pricing for cuts relative. We'll get a new dot plot at the December meeting, and we're likely to see a lowering of expectations for rate cuts in the future. Page 48, please, Sherry. This is a new report that we added at the last investment committee meeting, and it shows the performance for the internally managed portfolios. While this information has always been available in the full asset class performance reporting we we wanted to break it out and kind of highlight it separately. As you're aware, the majority of these assets are managed passively and intended to provide inexpensive beta exposure to more efficient markets, while providing staff flexibility and rebalancing the overall portfolio's asset allocations. Additionally, staff manages a number of proxy portfolios, which serve really as transitional positions for alternative asset classes as we look to deploy capital into new mandates or have already committed capital called by existing managers. These proxy assets are intended to provide exposure via liquid assets with similar return, risk, and economic characteristics as their target private asset classes. All of these portfolios performed in line with expectations and markets during the quarter. And I would highlight, we've talked about this in the past, the scientific beta portfolio. It's a factor-based portfolio. It outperformed during the quarter, consistent with the rotation that we saw in public equity markets. And while this portfolio's longer-term performance has been consistent with the strategy, and that's really that factor-based strategy, we are in the process of evaluating public equity alternatives that may provide a better fit for the overall portfolio allocation. Again, if we look at the performance here, it's benchmarked against something that really isn't managed in a similar manner or that doesn't have the same risk characteristics, but it's performed in line with how we would expect a factor portfolio that's constructed in a similar manner to perform, but it's underperformed broader markets. And we think there may be a more efficient use of kind of a risk budget and capital. So that's something we're likely to bring before the investment committee over the balance of this fiscal year, hopefully into the beginning of calendar 2025. Page 62, please, Sherry. Thank you. For the quarter, across the portfolios, the largest contributors to outperformance were the relative outperformance in the real return and real estate portfolios, while underperformance in the private equity portfolio relative to its public equity benchmark was a modest detractor. The real return portfolio produced a return of 6.70%, which outpaced the return of the benchmark by 573 basis points. The portfolio's performance was bolstered by strong performance across the recently approved and funded real return mandates, all of which outperformed their benchmark during the quarter. The portfolio's MLP exposure continued to produce solid performance with a return of 5.99% for the quarter versus its benchmark return of 72 basis points. And that portfolio is up over 33% over the last 12 months as strong cash flows, disciplined CapEx, and consolidation have continued to benefit the industry. The real estate portfolio produced a return of 1.71% during the quarter, outpacing the benchmark's minus 66 basis point return. Relative outperformance was driven by the portfolio's open-ended core strategies, which were able to produce positive performance during the quarter, although the last 12-month performance has remained negative for the portfolio. These strategies have benefited from lower exposure to the most stressed parts of the market, including the office sector, which continues to struggle. Over the past year, the real return portfolio has outperformed its benchmark by almost 11%, which has contributed close to 100 basis points of outperformance at the overall fund level. Conversely, the private equity portfolio, as we've discussed on many occasions, has underperformed its public market benchmark, the Russell 3000 plus 3% lagged one quarter, by almost 23%, which has been responsible for between 150 and 200 basis points of underperformance relative to benchmark at the overall fund level. Page 74, please, Sherry. Always some of my favorite Wilshire charts, comparison to our peer universe. And while the portfolios performed well in absolute terms, as expected, given their lower overall risk profiles and lower allocations generally to public equities, they underperformed from a broad peer perspective over the last year. Again, that's a year when especially U.S. public equities consistently hit all-time highs. That lower risk profile of the funds is evident kind of in that middle graph, that standard deviation, which again is consistently, in this case, top 10, top decile relative to the peer universe. All of the portfolios have continued to deliver top decile or top quartile risk-adjusted returns over 3 and 5 year time periods, which really demonstrates the efficiency of the construction and management of these portfolios. And that's what we focus on. Again, we're given the asset allocation by the investment committee and the board. Those are kind of our guiding principles and our marching orders. How we implement that really shows through in these Sharpe ratios, which again have consistently been top decile, top quartile in this peer universe.
Steve, I'm just gonna
Yes.
jump back 1 second to add to what you said, thinking about these numbers and then your comment on the last page about private equity. And I know this is repeating what we said before, but just so anyone who's not really close to this market is aware, that is entirely common right now in the short term with these public equity markets running like they are. Private equity portfolios that don't mark daily just look entirely different in this short term. And so it's really about the long-term picture and how it produces, how it's productive, over the long term. But quarter by quarter, it's just so difficult.
And David,
Absolutely. Yeah.
one other point to make that I think is very important here is when we look at the universe here, it's all public plans. And this is going to include plans that are much smaller than KRS. And I bring that up because those plans that are much smaller are going to have larger allocations to public equity, which kind of drives the universe up from a return perspective from that perspective. So while you're looking at it, 85 to 90th percentile here, just keep in mind that you're being benchmarked against all public plans. And some of those public plans have very different allocations than yours. Some are much more equity concentrated.
Yeah, I think as we've talked about in the past, the larger plans that have larger exposure to alternatives, we're much more in line from a performance standpoint with those. We've talked about last investment committee, we did that the presentation on private equity, relative performance, and potential for benchmarking. And I think that's the discussion we'll have as we look to update the IPS. Is we talked about there's no great benchmark for private equity. There's a lot of different approaches that different plans or different systems use. There's not something that meets, it's widely accepted. I think the public is using a public equity benchmark is widely understood. People can, it's visible. It's a published benchmark, so people understand it. But in periods of significant performance differences between the asset classes, it's going to show up obviously in our performance relative to benchmark. Page 86, please, Sherry. Thank you. As of the end of the quarter, all asset classes for each portfolio were within the IPS specified range, with the majority of positioning within about 150 basis points of the respective target allocation. As you'll see, we've maintained a modest overweight of approximately 2% to public equities. That's really based on that continued market momentum and economic strength. So we have taken opportunities to rebalance away, but we've kind of maintained that modest overweight to public equities. And while the relative overweight that we talked about last meeting in non-US public equity markets performed well during the quarter, recent rebalancing activity has been focused on moving the portfolios to more of a neutral stance, US, non-US, and we've begun implementing a relative overweight to US markets based on divergent economic and growth prospects. In the core fixed income portfolio, we are currently neutral overall duration, and we don't find a compelling case to implement a view, either long or short duration, kind of anticipating a continuation of that range-bound trading environment over the balance of the year. As David mentioned, the 10-year, which is typically the most common reference point on the curve for when we discuss rates, has traded in about a 4 to 4.5% range. We don't anticipate that's primarily based on rate expectations as well as economic expectations. We don't anticipate a breakout from that range anytime soon. So we kind of look at it really just maintaining a neutral stance from a duration perspective. The largest underweights were in real return and private equity. Managers have continued to call capital in our real return portfolio, and we're in the process of evaluating additional mandates, and we would expect all portfolios to reach their target allocations by the end of this fiscal year. As we've discussed many times in the past, we've maintained our modest underweight to private equity target allocation as we see limited value in the asset class from a relative basis with better opportunities in other asset classes. We have, however, begun to focus more on the asset class as recent underperformance and funding difficulties have created a more attractive landscape and potential entry point for the asset class. So we're likely over the balance of this fiscal year to look at potential new mandates in the space. Page 102, please, Sherry. As of the end of the quarter, there were no investment compliance issues to report, but much more importantly, I'm very excited to report that Carrie Bass has started as our new compliance officer. She's already begun working on overhauling a much needed overhaul of the compliance function and reporting. So we hope in the coming quarters that it's going to be a more robust and transparent report. But happy to report that as of the end of the quarter, there were no compliance violations, investment compliance violations to report. Page 125. At the end of the first quarter, 16% of the amount budgeted for the fiscal year had been spent. The largest outlier was legal and auditing expenses, as it continues to be, where only 7% of the amount budgeted had been spent, but we anticipate a significant uptick in legal expenses over the coming quarters, as there are a number of cases where activity has picked up. So I think some of that has already been billed. We've already seen some of those invoices come through, and they're just not accounted for yet as of the end of the first quarter. All of the other categories are in line with the budget. I would note, you may notice the Slovis line item, which shows 107% of the amount budgeted has already been spent. And this service is billed once a year and has already been paid for the full fiscal year. So that's the totality of what will be paid for fiscal 2025. I would also note that we've budgeted for an additional private markets consultant to complement our existing services. And we've included a miscellaneous service line item in anticipation of adding some additional independent research providers over the course of the year. Page 128. For the first quarter, investment fees and expenses were $4 million more than in the same period last year. As the table highlights, there is significant volatility as to the composition of total fees and expenses, with the largest drivers being the performance fees and miscellaneous fees and expense categories. We like to focus just on the investment advisory fees, which are the base fees the systems pay to external investment managers. And I would really note the consistency across time, with only a 5% increase in fees since fiscal year 2021, despite a 50% increase in total assets in the systems. Staff continuously evaluates and negotiates management fees to ensure the effective fee rates paid by the systems are low by institutional standards for the asset class and asset strategies that we invest in. As the table shows, there's been significant volatility in performance-based fees across asset classes, especially in alternative asset classes, where the fee structures are more heavily skewed towards variable performance-based fees. We've noted several times we've also continued to see a sharp increase in miscellaneous expenses over the last 2 years. And those are for strategies that rely on credit facilities, and that's given the significant rise in the front-end rates. Specialty credit alone has seen an increase of $9 million over the course of the last 2 years. Just as a reminder, these credit facilities are a key component of these investment strategies where the portfolio's investments earn a spread above the base rate, either LIBOR or SOFR. So despite the cost of the facilities increasing as rates have risen from the zero lower bound, the portfolios have benefited by earning more on the investments that they've funded. I would also highlight that the reduction in core fixed income investment advisory fees have been flat over the last 2 years, and that's despite a 56% increase in the market value. That's been driven by the rebalancing of the portfolio, including bringing a sleeve of the portfolio in-house, which ultimately we expect to reduce fees by $1.5 to $2 million per year. So there I will stop for any questions, comments.
Steve, I guess being the non-resident expert here, with absolutely no expertise, I guess I'm interested in looking beyond just the sort of the technical results from this quarter. There's a narrative that goes along with the Kentucky pension system, one that is fueled by sort of the chronically underfunded status of the fund. So much so that it was showcased as the one or two least funded pension systems in the country. And some media attention was focused in the past on the ways in which decisions were made for investments that were chasing sort of both the desperation and urgency of trying to fill the holes of that unfunded status. That it meant that the risk return ratios were conversations around that and decisions around that were fueled by sort of this idea that we had to take big swings with the hope that we'd hit a home run every once in a while. As a result of the legislature's commitment, both to the ways in which the system is currently funded and their generosity in pumping additional hundreds of millions of dollars into the system over the last several years, obviously the funding percentage to benefits promised has improved rather significantly, reducing to some extent that feeling of desperation. But as trustees, it seems that ultimately our obligations are not only fiduciary, but to assure ourselves that we're making progress towards ultimately assuring our retirees and those who are paying into the system that the promises we make to them as a Commonwealth will be kept. And so while all of these numbers are great, I guess what I'm looking for is how in simple terms would you explain to our retirees how the prudence, the risk assessment of the investment choices we're making are designed to place us over time in a better position? Because some would say, well, gosh, if you guys had just put this whole thing in the S&P 500, take your billions of dollars and put it with Fidelity, the rates of returns would be through the roof. So why are we getting the rates of returns that we are? And why aren't we making up more ground by making that kind of an investment? So I'm just interested in what you would say to our retirees with regards to how do the goals around our investment strategies provide some reassurance that we are prudently working over a long-term strategy to provide the kinds of returns that are necessary to ultimately, incrementally get us into a place where they have greater assurance that the promises that the Commonwealth has made to them can be kept. And I'm sorry for the existential nature of that question, but my guess is there are a lot of retirees that would be interested in a better understanding of that. This is their money, and I think we would just want to be able to assure them that the choices that are being made represent a considered and expert approach towards achieving that goal.
So Steve,
That-
maybe I can start off on that. Thank you for the question. I think that's a great question. Rebecca and I just testified to PPOB this week, and we talked about that commitment versus, capital behind it. We're focused on a 2049 strategy. That's the closed amortization, where the commitments that we've made, the Commonwealth, will equal the capital that's behind it. So we got a long way to go. So that's kind of a global answer. So again, and I'll defer to Steve on the balance of kind of the investment strategy.
So I think it's a great question. It's a great topic. This could actually be an entire meeting or multiple meetings. I would go back first. The you're right that unfortunately the systems are always on a list that we don't want to necessarily be on. But I think we're making progress and moving in the right direction. And substantially that progress, there was a point in time where there was liquidity concerns with the systems, and that was partially due to uncertainty regarding funding, and that's been alleviated, and that's a huge benefit to the systems, all the participants, and that's actually allowed. We were deferring investments or preferring investments that had a certain liquidity profile that oftentimes over the long term had a lower expected return. You typically earn more for taking liquidity. There's a liquidity premium to investments. So we were not participating. Some of the systems were not participating in certain investments that had an expected higher return because they had a stronger preference for liquidity, given what was going on in the systems. One of the things you'll hear consistently in the pension world is you can't earn your way out of underfunding, regardless of how you position a portfolio, how much risk is prudent to take in a portfolio. So the certainty of funding that legislators have provided us has been a huge benefit to the systems, to participants, to retirees, and has allowed us to adjust the profile, the risk profile. One of the things I would point to is to prudent management of the board and the investment committee has been the most recent changes in the asset allocation and the IPS. We took an opportunity, and the investment committee and the board took an opportunity to actually reduce the overall expected risk of the portfolios while maintaining the expected level of return. That's prudent investment management, taking an opportunity presented by the market to lower the risk of the profile of the portfolios while maintaining the expected yield or return of the portfolio. A differentiator too is again, we're a system, as Ryan just mentioned, with a very long time horizon profile, which is going to be very different than an individual investors. One of the key tenets of prudent investment is diversification. You're right. There's a lot of times when we could it's the buy the lottery ticket, buy cryptocurrency. You can take a very high risk portfolio hoping for an expected return. Now they tend to be bifurcated. It's either really works out really well or works out really poorly. But our prudent approach is to just outperform our assumed rate of return. And it's been, the board's been very prudent in what they've established as their assumed rate of return. Is we were one of the first systems in the country to lower it, kind of given expected capital market assumptions going forward. We're still, I would say one of the more conservative from that standpoint, which is a great benefit to the systems, to the assurity of reaching that fully funded status in the time frame that Ryan mentioned. So that's something we consider. We look at when we're implementing and building out the portfolio. What's the risk tolerance of the portfolio? What's the expected return? What's the appropriate amount of diversification? I don't think, we hear that a lot, whether why not be all in U.S. public, why not be in Mag 7, right? I mean, you would have had a tremendous return, but the problem with that is the risk profile of that type of portfolio is vastly different. And from a prudent investor standpoint, diversification, as outlined in our IPS, is a key tenet of managing these portfolios. So, that's the hard work we do is where's the appropriate level of risk? Where's the appropriate level of liquidity versus illiquidity balance? And that's something that this committee and the board look at with our asset liability studies and our asset allocation work that is done. Asset allocation is reviewed continuously and at least annually. Full asset liability studies are done every couple of years. So all of that information is taken into account in building the most efficient portfolios, which again, I go back to, my favorite Wilshire chart, and what this system has been able to accomplish is the amount of return per unit of risk that they've been able to achieve is in Wilshire's broad public universe, some of the best out there. That's the testament to what this committee has been able to achieve and what the management of the system's assets are able to achieve. So I'm not sure that answers all of the question, but I think that's probably worthy of a conversation, because I think we owe a duty to participants and beneficiaries, both to assure them that their assets are being managed in the best possible manner, and that we have a path and a plan to full funded status, and the benefits of those retirees are certainly, in being managed well.
Well, I appreciate everyone's forbearance in the kind of open-ended question I had, but I always think it's important to sort of reset context as we think about this. The end of the year is often at times when we could expect some of our members to be checking in, and I think just creating a record that indicates we consider those kinds of perhaps in not the partisan sense, but in just the political sense. We recognize that this is a public trust, and for people to just understand that there are really good folks that are looking after these issues. So I appreciate that.
Yeah,
Yeah,
Steve, could I add just a couple of sentences
Sure.
to that? I think David Atkins, I think that's a great subject that you brought up. And I love what Ryan said. I love what Steve said, the 2049 plan. And Steve, I just reiterate everything that Steve said from an investment perspective. While you were talking, Steve, I was thinking, well, there's that old equation. The only way to fill that gap is contributions plus investment return. That's the gap filler. And if everyone knows the story that you outlined, David, that it takes contributions here. It just bottom line, it takes contributions, but at the same time, your beneficiaries would want you to be so prudent about how you manage that component of that equation, which is investment return. And Steve, you're just right on it. You've responded to being able to take on more liquidity once contributions were increased. You've responded to the current market environment where you're able to reduce risk without reducing return. And beneficiaries should be happy that you literally are maximizing your return per unit of risk. So that component of the equation, even though that's the smaller component, it's still so significantly important.
Those are great points, David.
Yeah, and I would just emphasize, I think the working relationship we have, the staff, investment staff, and Wilfer has with both the investment committee and the board is really key to achieving those goals. I think that the last work done on that IPS and the anticipated work on the next draft of the IPS, which is a living document, as Wilshire likes to say, we're always working on that. That really goes to, we have the same goals and objectives, and I think that working relationship really plays out in the performance of the systems.
Totally agree.
That was a great one. I'm not sure anyone wants to follow up on that question, but if there's any additional questions, happy to answer.
Yes, try to top that one.
Okay, seeing that there's nothing else, does anyone have any other comments or questions? Or are we ready to adjourn? Okay, there being no further business, this meeting is adjourned.
Thank you
Thank
very
you.
much. Appreciate everyone's time.
Bye, thank you.
Bye.
Everyone.
Happy Thanksgiving.
Oh, happy
Thank you.
Thanksgiving.
Yes, happy Thanksgiving.